Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zach's Market Edge.
Welcome to Zach's Market Edge, the podcast about investing in your life. I'm your host, Tracy Reineck, and this week I'm actually joined by a guest, by Zach's senior strategist, Kevin Cook, and he's here to talk about the strategies to help us be a better long-term stock investor, because it's harder than you think to buy and hold. The average time for most investors to hold a stock is now 18 months or less. So not even 2 years. This is why a few years ago, before the coronavirus pandemic, I had a hard time finding anyone who owned some of the big tech winners for even 10, 20, or 30 years. And forget about buying that IPO and holding. I didn't find any of those, although some in the financial media did manage to find at least one person who was willing to come forward and say that they bought the Apple IPO back in the 1980s and never sold. But it's pretty rare to find someone who's even bought even recent IPOs. So for example, Facebook IPO'd in 2012. So we're only in the 9th year. It seems like longer, but it's only 9 years since that IPO. Those shares are up 769% since the IPO, and that was one of the biggest and hottest IPOs ever at the time when it went IPO in 2012. Everybody was buying, and even here at Zach's, I was writing articles about how people were buying it to put in their children's college fund and things like that. But how many still own Facebook after they bought that IPO? Are you still in it just 9 years later? And why is it so hard to stay in a stock? So I brought Kevin on board today because he's telling me he has some kind of magic secret sauce that now helps you and me and all of us to stay in a stock instead of giving into our worst impulses and selling some of these great companies. So welcome, Kevin.
Hey, Tracy. Yeah, I don't know if it's a magic secret sauce, but it's something that I have found really helps me, and it took me a long time to learn it, but I think it can help other people too.
Okay, good. That's what we all need, because it is pretty grim out there. I keep seeing things where, someone might own one of the stocks for 6 months, and then they're wondering, because it hasn't done anything, it hasn't gone anywhere in those 6 months. And they're like, oh, maybe I should sell this and get out of it because I'm only up 2% or whatever it is. And that's not long-term investing. That's a pretty short term.
No. So do you want me to jump into some examples that I think sort of tell the tale?
Yeah.
Okay. So obviously, the Corona crash freaked everybody out. And I'm not talking about the pandemic. I'm talking about the crash in the stock market.
Yes.
So it made life difficult for lots of investors.
Yes.
Now, but look how quickly the market, shook it off, right? We knew we were going into this recession, that sort of a forced recession when you shut down all these businesses and everybody's out of work and unemployment, spikes. But the stock market came back pretty quick, almost as if it was it was pricing in a flash recession that was going to be over soon enough.
Yeah.
And then there was the other element that nobody really predicted, and that was that that software would just explode because everybody's working from home. All these stocks took off. And so you started to sort of see that trend, and you could jump on board. The one thing, now maybe some people predicted the software resurgence. What very few people predicted was the semiconductor bounce back, right? Like I thought after the trade war, supply chains would be shut down even worse with the Corona pandemic. And then semis just started to move too. So you had to jump in there quick. Now, so aside from software and semis, I'm going to give you one example of a stock that really got away from me, and that is Align Technology. the maker of the Invisalign clear dental straighteners.
Okay, what's the ticker on that one?
ALGN.
Okay.
As you probably know, and we've talked about the company before, I've been a big fan of this company for several years, let's say going back at least 4 years. And just because of the growth opportunity, that they had some patent battles like with Smile Direct and, partnership issues, and there was going to be competition, but they were the clear leader, pun intended. And, and I always looked at the international opportunity, because it's not just the clear aligners, it's that they could do everything digitally. So imagine people in remote areas in India or China who could have access to a digital scan of their mouth and then have shipped to them a clear aligner. I mean, to me, that just looked like a huge market opportunity that would make Align terrific. Well, of course, I got panicked out of Align shares probably even before the Corona crash. I got panicked out, like near $200. It's trading 600 now.
Wow.
Let me give you another one. CrowdStrike. CrowdStrike is cybersecurity, and they have some special methods and proprietary tactics for protecting companies from, say, ransomware or other nefarious, internet ploys. This was a stock that had gotten beaten down from its IPO back down to $50. And I did a lot of homework here, and I thought, man, this thing's a steal at $50. And we bought it, and we made a little bit of money, and then we got flushed out of it below $40 during the Corona crash, trading new highs above 250 right now. Now, I'll stop with those two examples right now, and let's see if you have one. I've got more, but the main message I want to say is, there's thousands of stocks out there, and companies. We think about companies and industries. If you're a fundamental investor, you're looking, hey, what is this industry, and does this company have a competitive edge? When you take the time to do the homework on a company and its stock, I think that you have an edge, and that edge is that you have conviction and you have focus. When millions of investors are getting distracted by the thousands of other stocks, you have an edge over them because you're looking at that stock going sideways at a some kind of value level, and you're like, this is going to work. This is eventually going to pan out. And that's what I believed with Align and CrowdStrike, but I didn't stick to my guns. And you don't need 50 stocks to be a winning investor, right?
Right.
You can do it with 20 or 25 if you do your homework.
Yeah. That's the key thing is you shouldn't have 50 stocks. That would be too many for most investors. I have some of these stories too around the coronavirus sell-off. So many people know that I've been in RH, formerly known as Restoration Hardware, in my own personal portfolio for a number of years. And I'm a big believer in the CEO there, Gary Friedman, and what he's doing with the company. So, and I listen to the conference calls, so I'm aware of what's going on with their business. But on the coronavirus sell-off, I did decide to sell a portion of my shares, mainly because I wanted some cash on hand, given the uncertainty and what we didn't know, what might happen in the next several months and through the end of the year. So I felt like having some cash was better than no cash.
Oh my goodness. I'm looking at the chart right now. I see where this is going.
Right. And so I think I sold around $200, and it's almost, it has been as high as $700 now.
Yeah.
So that was a pretty, bad decision, it turns out, to sell some of those shares. But I do have to say I did take that cash as I thought I might do. And I did redeploy it into several other things that have rebounded, have had a nice rally as well. So it wasn't all for the not, but it was, not a good decision to sell out that one.
They just destroyed that stock during the Corona crash. I mean, it went from 250 down to 75.
Yeah.
Like, panicking everybody. Like, you probably felt lucky at first that you got out at 200.
I did. Yeah.
Exactly. When it went below 100.
Right. So anyone who was paying attention and could get in then, that was a smart thing to do at that time. But I guess that's the other thing too. If, there's no do-over, I can't go back and undo it, but I have, even in the value investor portfolio, we had to sell out of a number of things on the coronavirus sell-off too, just to contain our losses as well in that portfolio. And some of the holdings, I said, we're just containing our losses here, but we're probably going to get back in. And I was able to get back in to a couple things at pretty good levels when we got back in. So that's always a thing too, that just if you do end up, panicking and getting out, there's nothing that says you can't buy again.
Yeah, absolutely. Yeah.
So what was your experience with NVDA during that whole time period? Did you own it in any of your portfolios? Because I know you've been in and out of that one, right? And that's had an interesting kind of year and a half here.
Yeah. I was always a big NVIDIA fan and probably trading in and out of it. And that was the one thing I did right during the Corona crash. Okay. While I was getting knocked out of other things, I happened to be not long NVIDIA. And I said, man, we got to buy this at 200. And we did. And so that was me. If I talk about, having a homework and research edge and having conviction and focus, that's the one place I did it right, was buying NVIDIA during that crash. And just because I had such strong conviction there about, how they were dominating in their industry.
Are you still in it then?
Yeah. In fact, we just added more a couple of months ago, below 540, and that's turned out well as the stock makes new highs above 750. So yeah, I was going sideways there for a while, and I'm like, you know what, this thing is not done. There's such a powerhouse now in data center. Data center is going to overtake gaming. Gaming is still their biggest revenue source, but data center is growing 3 times faster, and it's going to overtake it this year. And, this company will do, $25 billion in revenues next year, or probably this year. But it could be doing $40 billion in a couple of years. And so I want to keep buying that growth. I just got an email this morning here. I want to read this email to you. It's really short, from somebody who follows me. His name is Tom, and this is a guy who knows exactly what we're talking about today, about buy and hold. And he's an older investor, and he goes, Kevin, hope all is well. I've owned NVIDIA for about 2 years now. Is it too late to buy more?
Well, that's a good question, though, right?
And that's his perspective, is like, he's never even thought about selling it. He wants to know if he should buy more.
Yeah.
And I just did a Zach's Confidential last night where I recommended NVIDIA again, but I said, don't buy it up here at 750. Let's see if we get some corrective action, have some bids layered in, say at 650. But in April, I took my price target to 750, and that was above every analyst on the street. And then they reported another blowout quarter, and then everybody went to 750. Well, then the stock went from 550 to 750 in like 2 months. Oh. So I've raised my price target again for 900 this year, and possibly, we're going to see quadruple digits. NVIDIA Well, it's going to split here soon, so that
Right.
so
Right.
well, it's going to do a 4-for-1 split. So maybe that's another reason people are diving in.
Yeah.
So, but
Now,
yeah, I think it's a long-term hold. Obviously, my customer Tom thinks so too.
yeah. But what did you do and what did you tell everybody in your service who was holding onto it, including Tom, over all of those months where it didn't go anywhere or do anything and actually kind of weakened for a while there and looked like
Yeah.
it might break down? Because I owned it. I think I bought it in November of last year in the insider trader, because there was an insider who was buying it around $500. And I was like, okay, we're getting in here. And then it was just treading water all those months, not going anywhere. Then it kind of broke down. I don't remember if we sold for any gain. I think we did, but it was very small. But I told them, like, we only have a 1 to 3 month hold period in that portfolio. And I held past the 3 months.
Oh, that was it. That was for insider.
Yes.
Yes.
And I believe it would break out. And I even told everybody, hey, if you have a longer term horizon, you should be holding on to NVIDIA here. And I'm trusting the insider who kept buying around $500 that, that it was still going to go higher. But
Right.
what did you tell everybody in your service as it just kind of treaded water? Because it wasn't just like a 2 or 3 month treading. It was like 6 months where it went nowhere. And that's like, seems like forever when you first buy a stock.
Yeah. So for me, this was one of those rare instances where I had done so much homework on the industry and looking at the future of artificial intelligence, and then looking at how Jensen Huang, the CEO, was creating stuff that just was, I mean, nobody could touch what they were doing in terms of hardware and software stacks. Their platform is called CUDA, which stands for Compute Unified Device Architecture. I had done so much homework. I was never scared of owning NVIDIA above $500. In fact, I kept telling my people, listen, when we get a dip to 450, we're going to double our position. And it never got to 450. But I was telling people, we got to be buyers under 500. And finally, I just had to pull the trigger and we bought more at like 535 before it ripped here. And so this was the one rare case where I had done enough research that my conviction was extremely high.
Yeah.
And we'll see this when I talk about some other investors in that area.
Okay. Because I feel like people are having the same kind of wavering issue with Amazon, which is also, until recently, it looks close like it might try to break out here again, but it's been a while since it's, hit some new highs and moved higher, even with the tremendous performance during, after that initial sell-off in coronavirus, and then the shares took off. But over the last 6 months, they're only up 9.5%. And again, a lot of people start to get a little anxious, like, oh, I missed it. It's done now. Like, that's where I think a lot of people in the buy and hold break down. They buy these momentum stocks, and then for whatever reason, there's like a bout of no momentum. And then they're like, okay, I need to get out of this. But how does someone stay in? Do they just not look at it?
Yeah, I mean, it all depends. As when you and I do these podcasts, and we've done these for years, during corrections, we always say you have to have a plan.
Right.
But during just general bull market investing that we're supposed to be doing, we always ask the question, what's your time horizon? What kind of money is this? And if somebody's in, from, let's say, $2,000 in Amazon, I mean, what are you really afraid of? Are you afraid of the next recession taking it back to 2000? Or are you afraid that, somebody's going to enter one of their businesses and steal their moat?
Right.
Excuse me.
Right.
I mean, they just made another killer acquisition by buying MGM Studios for $8.5 billion. I use that as my prime example when I pick on the AMC apes. The AMC apes are pushing AMC to a $30 billion valuation, and based on their price targets, they want to see it possibly have a $50 billion market cap.
Wow.
And I'm like, this is a movie theater with no content. And Bezos just made a steal buying the Bond franchise and everything else for just $8.5 billion.
Yeah.
So he continues to make some smart acquisitions. I don't know how Whole Foods is panning out, but they've got the cash flow, so they talk about a long-term perspective.
Right, for sure. What about some of these other kind of hot stocks like Shopify? That one looks like it's breaking out again here, but
I'm glad you asked.
Yeah, it was down double digits at one point here in 2021.
Was it? I didn't even notice.
Yeah.
Actually, we were buying down there. I was trying to build a position around 1100, and we did pretty good. We started buying around 900 last year and took some profits, and really I should have never played with it. And if you want, I will now reveal my secret, and Shopify is a great example.
Okay, yes, please.
Okay. So you run an insider portfolio where you have a discipline and a model where you look at the SEC filings, you run a screen, and you find out who's buying what stocks and do they fit, other criteria that you have.
Yeah.
And you have a consistent model. You run your screen systematically, every week or whenever you do it.
Yeah.
I don't know if you remember back in like 2014, I was running a portfolio called Follow the Money.
Oh,
and that was based on looking at the SEC filings, the 13 Gs and Ds, especially, 13F is like just a standard quarterly report, but the 13 Gs and Ds were like when a large institutional investor upped their position significantly to cross a threshold like 5% of the company or 10% of the company. And so I was systematically tracking what large investors were doing. Now, I'd already had a rough inkling that, hey, it matters what the big guys are doing. What's Buffett doing? What's David Tepper doing? What are the Tiger Cubs doing? That kind of thing. But when you get sort of systematic about it, it can really pay off. And, I had some good winners with that portfolio for a while. And then when I stopped running that portfolio and we rolled it into something else, I wasn't as disciplined about it. I was still paying attention to what large investors were doing, but I wasn't checking, at least several times a month or systematically every quarter when the 13 Fs come out 45 days after the end of the quarter. So I would say I was loosely paying attention.
Okay.
And what I've learned is that if I had stayed on my discipline of looking at who was buying what and when, I would have, especially in the stocks that I was interested in, like an Align Technology, or Square. Oh my gosh, I sold some Square during the Corona crash, and everybody hated Square, and then it finally exploded.
Right.
And Shopify is a great example. I just went over. Let's see, where can I find this? Oh yeah, so I looked at. I mean, Shopify has had a negative PE for forever, right? They're not making money, but the stock just keeps going up. And when you look back at the SEC 13F filings of which large funds were buying, two of my favorite fund managers were buying, and that would be Steve Mandel of Lone Pine Capital, who I've followed for years. When I ran the FTM fund, I followed him into Mobileye, which was the Israeli autonomous driving unit that Intel ended up buying for $15 billion. But Steve Mandel, he was building his Shopify position around $300 in 2019. Now it's a $1,500 stock.
Yeah.
I didn't follow him then. I looked at it and I looked at it and I looked at it. I'm like, this valuation is crazy. 40 times sales? Come on, are you kidding me?
Right.
But obviously Steve Mandel saw something in the future. And that's what a lot of these large investors can do when, it's not their money, but they are given the task of taking other people's money, other institutions' money, and putting it to work over the long term, not over the next 3 months, over the next 3 years or 5 years or 10 years. And so Steve Mandel saw something in Shopify that it was going to be a significant e-commerce platform that could take, maybe not take market share from Amazon, but to take a piece of the growing pie, a growing e-commerce pie. And what a brilliant move that was. The other big investor here is Bailey Gifford, which is like this is the old investment fund, insurance fund from Edinburgh, Scotland, still owned privately by like 30 partners in Edinburgh, $250 billion under management. They are long-term investors. They have been the largest holder of Tesla, and they have been the largest holder of Shopify, outside of a BlackRock or a Vanguard. And in many cases, the Bailey Gifford positions in Tesla and Shopify exceeded what a BlackRock or a Vanguard were doing. And they are uber long-term investors. They look at what could this company be 10 years from now. And they're not afraid to just hold on and buy the dips. And that's where you can, if you've done the homework and you need to sort of beef up your conviction in the idea, look at what the big, large, smart, long-term investors are doing, like Lone Pine or Bailey Gifford or Andreas Halverson of Viking Global.
That's a good idea, and it reminds me a lot of what I always say about the insiders too. That if you're wondering whether or not you should be buying a stock, I go there and I look to see if any insiders are buying, especially if there's some kind of big sell-off, not like a coronavirus sell-off, because most of the insiders were not buying during the sell-off for various reasons, but like some other event happens, or like the stock just sells off 20% on an earnings report that otherwise you thought was very good, but for whatever reason the street was rejecting it. I go in there to see what the insiders are doing. If they feel the same outrage that the shares should not have sold off or the shares are cheap, the insiders will go in there and buy. So it does, as you said, it boosts your conviction on your view of the company, because the insiders clearly know what's going on behind the scenes.
Right. And who knows the best? Who can know the company better?
Right.
Than officers. And it can't be a short-term trade for them. They can't do anything illegal. Like they know an event is coming up and they buy before that. They're buying. They really are buying for the long term.
Right. And they have to hold a minimum of 6 months under the rules. So there's at least that. But usually, they're buying for even the longer term. So it's similar to your fund buying, because those managers know these companies well, as you said, as well, the same kind of insight. So I don't see anything wrong with, getting a little bit of reassurance from other sources that, hey, maybe I'm on the right track with this company and I'm not losing my mind, because it is hard to buy if, the street is rejecting it or that kind of thing, and there's some kind of big sell-off, or these kind of stocks that are just treading water. That insider buying at NVDA at around $500 was like a boost to the conviction, like, hey, this guy's on the board. He's been around for a while and he knows what's going on behind the scenes, yet he's still buying here at this level. So,
yeah. And I would say, they know the company inside out and behind the scenes, as you say, but they also know all the information that's publicly available about the industry. It's just that they've studied it more, right? They've looked at the industry trends, let's say for a line in, what is the market potential in emerging markets for clear dental straighteners, or for NVIDIA, what are the growth trends in artificial intelligence and data centers, and mining and modeling data for corporations, or robotics and automation. I mean, NVIDIA does so many things. Like I just highlighted last night that they basically build these incredible toolboxes for any company to create their own robotics, and create their own automation. So it's like a corporation can, like off the shelf from NVIDIA, buy something that will help them retool their factory or, get new jobs done and create new productivity or enhance the productivity of their employees.
On another kind of strategy, what kind of strength do you put in, if any, into what the covering analysts are saying about a certain company, or even if they downgrade from, perform to underperform, or from buy to even a sell or something like that? If you're a long-term investor, do I care what any of these covering analysts are, ranking or rating the stock?
I would say yes,
Okay.
but with sort of a filter. And the filter is that once in a while you'll get a smart analyst who's done his or her homework, and they'll stick their neck out and they'll be like, they'll have a high price target and revenue projection that's 25% over the rest of the street consensus. But mostly they don't try and stick their neck out too much. So you sort of have to read between the lines. Now, there are two areas that I invest in, or three areas actually, that I have to rely on analysts because let's say so the three areas would be biotechnology, semiconductors, and software. I mean, sorry for that. Hang on one second. So you think about those three areas, you or I, we can't be really in the weeds specialists in those areas. It's just too much.
Yeah.
So and the analysts can't be experts in all three of those areas either. You really have to, when it comes to these industries like semiconductor, software, biotechnology, you have to be super specialized and really do your homework. So that's where I rely on them for, what are they seeing in lots of different details? Because they get into the nitty gritty. They're like, okay, I mean, everything from, a biotechnology company, they're coming up on, phase 2 trial results or an FDA ruling, or they're going to do a stock offering. And then in semiconductors, oh my gosh, what a complex industry that can be. I mean, there's so much, there's so many details about supply chains and who makes what for who. And then software is, they have to analyze who's buying this. You think about SaaS, software as a service. In the Fortune 1000, all of these companies have like over 50 different SaaS subscriptions. So these guys have to track all these trends and see which ones are picking up, the most revenue growth on an annual recurring basis. And so that's where I really rely on the analysts. And then when I get to know an analyst, and I have my favorites in software, and I have like 2 favorite analysts in software, and I have about 3 in semiconductors. Once I get to know their style and their track record and their success, then I can really read between the lines. What are they saying? So, like Mark Lepacius from Jefferies is great in semiconductors. William Stein of SunTrust, those are great guys. Brent Bracelin in software, and then SVB Leerink, which is the Silicon Valley Bank in biotechnology. They're awesome. And Jefferies has a good team too with Michael Yee. So you get to know them and read their research. It can help you, decide, am I just trading this short term, or is this something I can really hold and buy the dips on for 3 to 5 years?
Yeah. Oh, that's good advice. Okay. So is that all the secret sauce? Is that all you got?
I mean, that's pretty much it. This is like if you've done the homework and you want to keep your eyes on the prize, it helps to see what somebody's doing. How about David Tepper and Micron? I mean, David Tepper he was buying Micron at, $30 and $35, and just, he had to endure a long period of sideways, many years, as the semiconductor cycle was crashing yet again.
Yeah.
And now he's been rewarded. So there are many large investors where if you look at their 13F filings, do they keep adding to their position? If they keep adding to their position, 8 quarters in a row, That's a lot of conviction, and they must see, that the company has not reached its full potential and valuation.
Yeah, that's a good point. Okay. Well, I feel like we've given, some good insight to those who are wavering or want to be long only investors and hold for several years, but kind of get freaked out or panic every once in a while. That maybe this podcast will help them stay in there with companies that are still solid and have the growth potential and all those things. So let's recap some of the tickers here. We talked about quite a few companies, so I'm just going to list them. We talked a little bit about Facebook because we're coming up on the 10-year, the IPO there. Maybe some of you own it. I own it in my own portfolio, but I did not buy the IPO. I was dollar cost averaging on that one. Ticker FB. Then my horrible RH investment, that's ticker RH. Kevin was in Align Tech, but panicked out of that during the coronavirus. ALGN, also similar for CrowdStrike. CRWD. Then we had NVDA. Kevin stayed in there, but my insider trader had to get out before this nice rally, unfortunately. NVDA is the ticker. Amazon, that's just been kind of meandering for the last 6 months, not doing much. I also own that one in my own personal portfolio, but I did not buy the IPO on that one either. IPO'd in 1996. Amazon AMZN. And then there is Shopify. That one is busted out again after having some difficulties here in 2021. So I don't know how many of you stuck around in that one.
Hey, Tracy, if I can just interrupt you on that one. Even though I didn't follow Steve Mandel at 300, like I said, I learned to buy it like even at $1,000 and $1,100 because I just have greater conviction in it. So we took 35% gains on the move from 1150 to 1550, just on part of the position. And
Wow.
I'm still holding, looking for 1700 there this year.
Okay. It's really hard, I think, for most investors to be buying these stocks above $1,000.
Yeah.
It just is. But
yeah. Well, I mean, even if you buy 5 shares, you're
right.
It makes you do your homework.
Oh, for sure. And yeah, you're going to have strong conviction if you're in these at that level. So Shopify again, SHOP. And then we mentioned Micron there at the end. I own it in the value investor portfolio, but it hasn't done anything really since we added it a couple months ago. But we're waiting on those earnings, which are coming up at the end of June here in 2021. So ticker Micron MU. And as always, be sure to subscribe so you don't miss a single episode of The Market Edge as we're bringing you all of these hot topics. And there's a lot going on here in the summer of 2021. So you can get us on Spotify. You can get us on Amazon Music. You can get us on Apple Podcasts. And as always, we're on SoundCloud. But be sure to get us somewhere. And I'll see you again next week with some more stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.